Hey everybody, thanks for coming tonight. I was thinking about doing a presentation, the past couple of weeks. We're still beginning the school year. We're trying to figure out, get them into the flow of class and stuff. So I thought it would be a good idea to do this presentation, just informing people about the World Bank and the IMF, and just pretty much what they do, who they are, and just about those institutions. Because I know, I'm a senior now. When I was a freshman, I kind of had no idea what they were or what they did. So hopefully I can inform some people and give you some insight, maybe if you potentially want to end up thinking about working there. So, before I start talking about these two institutions, I just need to briefly talk about Bretton Woods, which happened in 1944. Pretty much Bretton Woods was right during the end of World War II, and it was a big meeting between many of the major powers, the United States and the United Kingdom in particular, where they debated about the future of international finance markets. So pretty much they had some great questions. How can we prevent another depression? Well, we need to control these new international financial markets. As you know, in the 30s, there's a huge financial depression in the United States, and they're thinking, well, what can we do to prevent something like this from happening in the future? Additionally, how can we contain the spread of communism? The United States, obviously, is always looking into what it could do, especially during this time period, the beginning of the Cold War, to prevent communism from spreading. You've probably all heard in your history classes, containment. And these institutions that were created in Bretton Woods can actually be an extension of the United States policy for containment. What did it do? So it looks like that picture kind of cut off, sorry about that. But it linked the world markets to the US. How did it link them? Well, it pegged all the world currencies to the dollar, and then the dollar was actually pegged to gold at a price of, you can't see it, $35 per ounce of gold. Also, additionally, before I move on to Washington, I just want to briefly mention the IMF and the World Bank, the most important things I'm talking about, were created at the Bretton Woods Conference. Their ideas were consolidated there, and then a couple years later, they were created, and then the World Bank actually had, throughout the years, many more iterations of the World Bank, which I'll get into throughout the next years. So the next thing I just want to briefly touch upon is the Washington Consensus in 1980. This is the second big paradigm shift. It pretty much involved the breakdown of what I just talked about, the Bretton Woods system linking everything to the US dollar. Well, it was still linked to the US dollar, but it wasn't really linked to gold anymore because the dollar wasn't backed by gold anymore. It was liberalization of the international financial system, and there was a lot of debt crisis going on in the 1980s. Pretty much, this really generated a lot of need for the IMF to give out loans to these countries because they were trying to protect the international financial system from melting down again, like it did in the 30s, and like it actually has recently. So, insured payment. So what did the IMF do? It's trying to insure payments. What are these payments for? Well, all these countries are taking out loans, essentially, from the IMF to meet their balance of payments and meet their short-term expenditures. So right now, if there's a country in a huge debt crisis and they'll call the IMF will come and give them some loans to help make ends meet, and then eventually they'll repay the IMF. The thing is, these loans are really to help the banks. That's not necessarily a bad thing, but it is because the banks need to get paid, so they get paid indirectly through the IMF lending these different countries its money. And also it does the IFIs, the international financial institutions, which is the World Bank and the IMF, which I will talk about in a minute in more detail, in net income for the IFIs. These institutions are given money from a quota system, which I'm going to also talk about, but at the end of the day, these institutions are also there to generate some profit because it obviously has to pay for their operating expenditure. So let's actually get into this brief description of hard power versus soft power, which is also going to come up in the next couple of slides. Hard power is essentially, as you see there, a loan contract with binding terms and a contractual obligation. So a loan or maybe a policy reform that when the IMF gives out a loan or the World Bank gives out a loan, it says, hey, you have to meet these reforms that we're giving you in order for us to continually give you the disbursement of this loan. Then you also at the same time have the soft power of these institutions, which could be an indirect influence, with papers that are produced, like here is the World Bank World Development Report, and it just talks about what they think is important in the field of economics at the time or the field of policy. And these things are less power-based grasp, but more of they're influential documents. So you'll see some more strict definitions of that in a minute. Let's talk about IMF and the hard power aspect. What is the IMF? Well, it's essentially the fire brigade. When countries go up in flames, the IMF comes, gives them some intermediate loans to help calm those flames. Emergency financing and balance of payment system. What the IMF calls is when a country's in fundamental disequilibrium, they will come in and help this country maintain its balance of payments if it owes a lot of money to a foreign debtor, a sovereign country, or maybe just international banks, the private sector. Also, it will help roll over this debt. Essentially, when the IMF lends money, it's giving these countries money, but then the countries is taking their debt that's owed to, say, a foreign bank, and now instead of going to the foreign bank, it owes the money to the IMF. So it's helping roll over the debt. A lot of times, there are going to be some negatives as I'm talking about the IMF, but it is actually helping these countries because if they can't make their payments to these banks, the IMF will come in, give them better, maybe sometimes better loan contracts that are maybe more favorable for the country. Bridge the gaps between their payments. So let's talk about the IMF soft power. Well, it does signaling and surveillance. It publishes these reports, and these reports are extremely influential. Essentially, these reports are put out there for anyone to see, and any investor can go look at this country. So say the IMF publishes a report about Greece. Any investor can go look at this report. Well, what's the status of the financial markets in Greece? What does the IMF think is wrong with Greece? And what are they doing to fix it? These reports, although are directly making Greece change its policy, can greatly affect Greece or any other country in the world by just the influential soft power nature. They also have this lock-in effect. So when the IMF gives money or loans money to a country, it puts these policy stipulations, say, oh, you have to decrease the regulation of this, say, a labor market or anything like that. And then maybe that won't actually bode too well for the people because the people don't want decreased regulation. Well, the country can then at that point go, hey, people, it's not us doing this, it's the IMF doing it. And actually the IMF is quite happy to take upon this responsibility. Even though people aren't going to be extremely happy with the IMF, it allows the IMF to get these loans in, and then the countries to kind of take the blame off themselves and put it on the IMF. It's actually kind of a symbiotic relationship because in the end of the day, the IMF does want to give out these loans. What else? Think tanks. It sponsors many think tanks across the world that publish working papers. It also controls the data. So there's a kind of a term, when you control the data, you control the discussion. When you are doing all this research with many top economic experts in the field, it's really hard to argue with those experts because they essentially know everything about economics or their specific field of economics. So it really gives the IMF a lot of leeway when it's talking to these countries. Specifically the IMF Institute, which is many IMF institutes over the world. What it does is they'll take central bankers and maybe finance ministers from foreign countries, and they'll come to this IMF Institute and be taught, this is how you should run your economy, and this is how you should finance your expenditures. They're not necessarily forcing them to do this, but it's a very, very influential, and it helps find interlocutors in potential clients. Because when the IMF is going in to take a loan with someone, or to give someone a loan, they need to find a potential client. And you can't just go to a country and ask the country, you have to ask, it starts with people. So you go to the country, talk to a finance minister, and that finance minister actually happened a couple of years ago to go to the IMF Institute. It creates a really interesting bond. Then the finance minister will have to go back and talk to the rest of the country, obviously, before it makes any final decisions. But it gives the opportunity for the IMF to go out and give these loans. So let's talk about some of the IMF's projects. So in the 1980s, it gave a series of loans to Mexico in exchange for some economic reforms that it thought were needed in Mexico. And Mexico did pretty well for a while. The problem is then in the 90s, Mexico started running into some problems. The IMF didn't really catch those problems. And even if it did, it puts itself in a difficult situation because it realizes there's problems occurring in Mexico with balanced payments and can issue more loans. But by going back and saying, oh, actually, things aren't going too well in Mexico, it makes the IMF look not that well. So what ended up happening is there was a rapid capital outflow in Mexico in the 90s, and they had actually a pretty bad recession. The IMF policies didn't work out that well in the end there. Then you also have Greece, Ireland, and Portugal, late 2000s, as we all know from the Eurozone crisis. There's a sovereign debt crisis and a banking crisis. Essentially, say in Ireland, the government took on all of this bad debt from these banks. And then at that point, Ireland could not cover because GDP was not even enough to cover all of the debt that the banks and its private sector incurred. The IMF was called in, gave it some loans to help meet its payments and obligations for the time being and protect the international financial system. So these are some examples of the IMF stepping in. Let's talk a little about the World Bank, because this can get a little confusing. So, the World Bank group is all of these institutions right here. I'm not going to really talk about MIGA or ICSID, because pretty much MIGA deals with risk insurance for international investors, and ICSID deals with legal resolution for international investors. But the main three I'm going to talk about are the two that are actually considered the World Bank. which is the International Bank for Reconstruction and Development and the International Development Association. Those are technically the World Bank, and everyone else is under the umbrella of the World Bank Group. Additionally, I'm going to talk about the International Finance Corporation, because that one's actually pretty important. So what do these things do? The International Bank for Reconstruction and Development lends to creditworthy low and middle income countries. The International Development Association provides interest-free loans to lowest income countries. So if you qualify for these loans, you can get them at extremely good rates that you don't actually have to pay back interest. And then the International Finance Corporation works with private sector in different countries. So let's talk a little bit about each of these again. What does the IMF, or what does the World Bank actually do? Well, the World Bank, and it's supposed to the fiber rate of the IMF, is more like a potholes and pipes type of person. They will come in, and they will do this thing called structural adjustment lending, where they will give loans to countries that will promote infrastructure development. Well, that was originally what the plan was for the World Bank. As time has gone on, it's pretty much become more general projects. It's now does some environmental issues. It talks about some societal issues, maybe gender. If it notices that there's a lot of gender discrimination in the country, it will come in, offer a loan to help maybe solve some of those policy issues. Originally, it had a lot of gross national product-based goals, and then under actually one of the directors of the World Bank, the president, Mickey Namara, he came in and said, well, we can't have all these goals be strictly based on data. We should have some things that maybe are a little bit more policy-based, because not everything is strictly quantitative. So let's talk about some of the soft power of the World Bank. They produce, similar to the IMF, the World Development Report, and this is extremely influential. It's a report that says, this is what's actually really prevalent in economics today. This is what's important. So one of the most recent ones was jobs, and they talked about what they can do, what countries should be doing, essentially, to promote job growth and their job and their economy, because obviously we all know unemployment is pretty terrible in all the places in the world today. They also do research grants and promote think tanks, which creates a civil society experts, and also reinforcing their paradigm of economics. And then they also have ex-ante conditionality, which is actually very interesting. Ex-ante conditionality, which I'm going to talk a little bit about conditionality in a couple slides. But essentially what this is instead of giving someone a loan and saying you have to meet these policy obligations, just by having these reports and these think tanks, they're influencing these countries to do these policy recommendations before they've been told to, because they want to get the loan. So say you have a country in maybe Latin America who goes, wow, we really could use some money for infrastructure development. Well, we know the World Bank is going to ask us to do this, and look at all these reports that they're these working papers and things like that. Why don't we go ahead and make these reforms and then go to the World Bank? It's actually sometimes, in many cases, creates a better environment, because then the countries can go through, issue policy reforms without being under the constraints of the sometimes stricter World Bank conditionality. So what are some projects they've done? Well, International Bank for Reconstruction and Development, done some things recently in Tunisia, actually, and this is a quote from the World Bank's site, is they improved the business environment by removing red tape. Well, removing red tape, it's deregulation, and advancing transparency through improved public access to information. So these are some things that they're doing nowadays that aren't necessarily they're building roads or building dams for energy. They're doing some things that actually might open up the economy to maybe influence maybe some more foreign direct investment or other things like that. Well, the IDA, right now, they were working with Nicaragua for a while, doing some rural development projects, standard World Bank things, and then also some gender issues. They noticed that there was, like I said earlier, some gender discrepancies, and they're trying to influence the political atmosphere and the policy to make it easier for, say, women to get some jobs. And then the IFC, it's actually working a lot with microfinance companies. For those of you who don't know, microfinance is huge in a lot of the less developed areas of the world where small companies are doing very small loans just to help kickstart some innovation and entrepreneurial spirit in these low-income countries. And the IFC, under the World Bank umbrella, helps with that. So how are they funded? Well, it's largely determined by both. You have the IMF, it's called special drawing rights. It's not technically currency, but it's a unit of account where everyone puts in money and then it's converted through an exchange rate to a special drawing right. And then the World Bank is just based in US dollars. And that actually generates your quota. So the IMF, right now, the US has about 17% of the quota, which is actually very influential because with the US having 17% of the quota, there's something called weighted voting. And you need a supermajority to disperse these loans. So for example, you need 85% to give out this loan. Well, the United States has 17%, so that means it can say no to pretty much any loan it wants, which can give a lot of power to the United States. The EU together has, what, 32%? That seems like a lot. Honestly, the EU doesn't always vote together on everything, so that's not the biggest deal. And then, for example, China doesn't give that much. It's actually, there's a very interesting formula. It changes a lot based on how much GDP your country has, and then a couple of other things to figure out how much quota you should actually be donating to these things. And they have a thing called the small quota policy, which is where countries have like a baseline quota. So these really small developmental countries, if they want to be a part of the IMF or the World Bank, they actually get a small amount of voting, more so actually than their GDP would determine through. They don't actually have to give as much money, but they still get to get some voting share, which is actually pretty good. So I'll briefly talk about the Polak model. The Polak model is actually the mainstay of the IMF for many years, and pretty much, let me just pull up everything there and go through it. It's based on a series of conditions. They identify crises in countries as short-term liquidity crisis or balance of payments, and they think that GDP growth should equal the money supply growth. They don't want inflation, and they definitely do not want an overheating economy. So what they do, the buzzword we all know, austerity. When they give a loan to a country, they go, here, we'll help you meet your short-term goals and your liquidity crisis because these banks don't have enough liquidity on hand, and they'll tell you, you got to reduce government expenditure, you got to increase your taxes, and reduce domestic credit creation. And they do a lot of these things, obviously, because they think it's good for the country, but also, in the end of the day, the IMF needs to get it paid back once it gives out money. So it's doing these things to ensure that the money will eventually come back to the IMF. Let's talk a little bit about conditionality. So when borrowing from these international finance institutions, countries agree to a specific policy prescription. So, for example, for the Eurozone crisis, Greece, spending cuts, tax increases. The thing about this is that when they gave the conditionality package to Greece, they said, oh, in a couple of years you're going to have pretty good growth. There's going to be a couple of years of negative growth, but then after that things will start improving. The problem is it's about 4 years down the road and things haven't improving. So sometimes the IMF and the World Bank, even though they have great economists and a lot of research, can't actually predict things perfectly, and then it can lead to trouble down the road. The problem with ex post conditionality. Ex post is the opposite of what I was talking earlier, where they're essentially giving loans and then making them do policy reforms after they give them the loans to continually get the disbursement. And the problem with that is that the discussions usually involve isolated, economically focused governmental areas. So, for example, they're talking to a central bank or a finance minister. That's not always the person who's making the major decisions in the government. It can be blocked by Parliament or other government organs. So what could happen is they could send someone to an institute. The IMF could send someone to the IMF Institute, a central banker. The central banker goes there, gets trained by the IMF, goes back to the country, and then agrees to the IMF to do some of these reforms to get the loans that it actually may as well really need at that time. And then the parliament of a country or another government organ could block the loan, and then you can't really go anywhere from there. There's been a couple times where countries have agreed to loans, and then a couple years down the line, the parliament or the government will say, no, we can't afford this anymore, and then stop paying back the IMF. Well, that doesn't bode too well for the IMF. They don't get very happy when something like that happens, and generally that country won't be getting another loan for a while. So what are some of the influences, the Western influences I just like to talk about? Well, the World Bank president, these are not written in stone. This is something that just actually happens. The World Bank president is always an American, as you can see right there. I believe he's Korean American, and then the IMF managing director is always European, Christine Lagarde, and that's just how it's always been. It's not actually written anywhere in stone, but that's how it seems to happen. And then Western influences. In the classification of the World Bank's the IDA. Well, the IDA is funded through a special fund that's a little bit different from the quota. Where contributors put aside some extra money for this special fund. And in the 70s, Vietnam was supposed to get an IDA loan. And what ended up happening is that the loan was getting ready to go through. They had everything worked out, and then Congress decided, well, we don't really want to lend this money to Vietnam at the time. Everyone knows the history of the United States and Vietnam around this time period, and the loan wasn't sent to the IDA because the United States threatened to cut all of its funding to the IDA at that time. So you can't necessarily blame the United States for this. Obviously, Congress is going to do things that I think is in the best interest of the United States, but there's some problems, as you can see, with some of the influence that the United States or other Western powers have in the IMF or the World Bank. So in the World Bank, there's no, in the World Bank there's an injunction that says you can't really be influenced by political situations. You lend equally to everybody. You don't really get into politics. They get into policy, but they're not saying, oh, you can't actually have this political structure or something like that. Well, the IMF doesn't actually really have that. They just say they shall respect the social and political policies of members. Sometimes there is a decent amount of political influence about the countries they're going to be lending to. And even in the World Bank, they don't really get involved in politics, but a lot of times, just from the nature of being infrastructure and policy development, they're trying to fix societal issues, which isn't necessarily a bad thing. They're helping, but they sometimes do get a little bit tangled into the politics of the country. Collaboration. Well, sometimes the IMF and the World Bank will work together and create cross-conditionality, where the IMF will give you a loan and the World Bank will give you a loan, maybe a short-term loan from the IMF, fix your balance of payments, longer-term loan from the World Bank to promote infrastructure and job growth. But then you get cross-conditionality, which can sometimes be a problem. You can look at it as good or bad. Essentially, what happens, if you think about it, is that you're being issued a loan from the IMF, but they're saying, well, we're going to keep giving you funds as long as you follow our policy recommendations and the World Bank's policy. So then you're really locked in. If you don't maybe meet a policy recommendation from one of them, you don't get the funds from the other. And that can create a really stringent situation for countries who, if you're going to the IMF, you're already in a pretty big crisis. So you're already at the lower end of the bargaining pole. Well, sometimes it can also fail. So in Argentina, essentially what happened is that the IMF wanted to wait to give this loan. They thought, Argentina, you're not doing enough austerity measures to fix your balance of payment issues. Well, the United States is actually saying, no, we want to give this loan to Argentina. And the United States has pretty big pressure on both the World Bank or the IMF. But the IMF wasn't budging. They said, no, we're waiting for further austerity measures before we actually give this loan. Well, the World Bank was under pressure from the United States also. And you know what the World Bank did? Is they just went ahead. They didn't think the IMF was right in waiting for more austerity. They thought it would be bad for the growth of the country and gave the loan without the IMF's help. The IMF wasn't too happy about that, and then actually for a period of time after that, they didn't really work together. They were in the means of creating a cross-policy memorandum between each other that will talk about how they'll issue loans in joint circumstances, and then that was canceled for a couple of years because they weren't too happy with each other after that. Here we go, pressure from the US government. The IMF wanted more austerity. The World Bank didn't. It ended up issuing its letter of development policy to Argentina and gave them the $1.25 billion loan. So where can we go from the future on this? How can the international financial institutions lend in an unbiased manner? Well, to be honest, it's pretty difficult. These institutions are funded by nations, and nations have sovereign interests. You can't necessarily ask a nation to give these institutions money and then say, well, we don't really care what you do with it. You can give it to our arch enemy. Not that that necessarily exists in any way or form, but you can think about it, the Soviet Union, the United States. That's probably the greatest example you could think of. Is ex-ante conditionality the future of lending? Well, maybe it's better for countries, instead of being issued a loan and saying you have to change all of these things, you have to deregulate or whatever the IMF or World Bank wants you to do. Maybe it's better for them to do it on their own and then go for loans. That's not always going to happen because countries have their own politicians and their own economic advisors who make their own choices. But in the end, that's probably the better way to do it because then these countries can go ahead and issue these reforms as it sees fit in the country, rather than the IMF coming in and foreigners assessing the situation and saying, hey, this is what you need to do, when sometimes they're not too sensitive to the issues at hand. And then, is it possible to create technocrat, which technocrats are politicians, a variety of definitions, so that's the way I interpret it. Create an institution that is open to new ideas. So this kind of self-enforcing policy paradigm, which by policy paradigm I'm saying you're trained as an economist from maybe a Western institution, and then you go work at a Western institution, and then you're continuing with colleagues who also have the same Western ideas. You're not going to go into the IMF. Maybe you have some far-out ideas, but then you're working on with other colleagues, and you're not going to bring that up. You're going to kind of go with everybody else. Is it possible to create an institution that maybe looks at these different ideas and doesn't maybe accept all of the crazy ideas, but actually looks at each idea and says, wait, why is this one good, why is this one good, why is this one good, rather than just saying, let's go in the straight line and kind of pat ourselves on the back by continually just reinforcing our own economic ideas. And that's kind of difficult, you know. I think the IMF and the World Bank are great institutions, and they definitely have helped in many areas, but there also have been a lot of areas where they haven't been too sensitive to the economic conditions of the countries at that time. But we'll see where the IMF and the World Bank go in the future. At the time being, they've changed tremendously from how they were about 20 years ago, where they issued some loans and policy reforms that pretty much told countries you have to completely deregulate and you have to open up all your markets, and then they created really bad bubbles in these countries. Nowadays, they're doing a lot better. They're trying to cope with issues at hand with the tools they have, but we'll see where it goes from there. So, here are my references, and does anyone have any questions or comments? Any questions? You hate the IMF, you love the IMF? Sure.
Well, there are situations where the loans that the IMF gives to the third world countries, like less developed countries, like put them into further debt due to like the interest rates.
What do you mean about that?
Like are the interest rates on the loans that the IMF gives to countries like
The IMF's interest rates, from what I believe, aren't exactly, they're not as contingent upon the income of the countries themselves. Like the World Bank has those special loans for really low-income countries. The IMF is more higher interest rates for short-term balance of payments adjustment, where the country's in a crisis right now, it just needs the funds to meet the bank's obligations. And then maybe from there, they can go to the World Bank and get a longer-term loan that might actually be lower free interest, depending on what the economic situation, development of the country situation is. So a lot of times, it is true that at the end of the day, these institutions are there to lend and help, but they are bank organizations, and they're there to make sure that their returns come back, because they need to continually, you could look at it from this way, that they need to continually get their returns, because then they need to go give money to other places too. It's not always, sometimes countries can say, oh, it's my country, but there's plenty of other countries too.
So, naturally, part of the funding from nations that goes to the World Bank is directed towards private sector development with the IFC. What say or influence do sovereign nations and government legislatures have, or legislators rather have, in how that money is spent in the private sector?
So the IFC, from what I know, they go to these countries and they'll talk to the countries, but then they go really straight kind of to the developmental sector of the private institutions, and they work with those private institutions to figure out what, based on their own policy assumptions, what that country needs. Oh, maybe this country really needs to work. It has the capacity to be a great agricultural provider or something like that, producer. And then they'll go to the agriculture sector, work with those people, and pump up that sector, because they think that will help the country in the long run. So they're really focused on the private side of the countries.
Sure.
The IMF and the World Bank write some fantastic, I mean, the researchers there, they write some brilliant papers. Has there been a certain one class of, let's say, school of ideology that they follow usually most of the time, or has that been changing, that paradigm shift? Has that been happening since the crisis?
Yeah, so that's what I was trying to do in the beginning. I don't think I did a very good job of it. But so when the IMF and the World Bank first created, they were under the influence of the Bretton Woods system. And then in the 80s is when they kind of said, hey, these countries, you need to open up your financial markets, liberalize, let capital inflow come in, deregulate your markets. It was a very big influence, obviously, from the United States. And that was a huge paradigm shift. And nowadays, they're actually kind of leaning back. They're not saying, open up all your markets, no capital controls. That's what they used to say. Capital controls, for those of you who don't know, is when you can pretty much stop money from flowing out of your country or in a country. So you can prevent a bubble or stop a bubble from bursting. The IMF for a long time, after the Washington Consensus, said no capital controls. But nowadays, they're saying, well, maybe sometimes there can be capital controls, because you might need to prevent a bubble from exploding or forming. So it has shifted. In the recent years, it has been taking a little bit more of an open-minded approach. The IMF in particular, from what I understand, it's a slow process. The World Bank is a little bit more open to ideas. Yeah, enough. So.
Okay. Thank you.
From your research, what have you seen that is most typical in preventing a country from receiving a loan, if ever?
If a country is going, say like the IMF, so if a country is going to the IMF and they don't get a loan, there can be two reasons. It can be like the political reason, where the United States or someone else blocks the loan from going through for various political reasons, or they might just not be doing the policy paradigms. These loans they don't just essentially go out and say, here, we're going to give you a $2 billion loan, here's $2 billion. They go, you have access to $2 billion. You can come to the IMF when you need it. You can use that account, kind of like banks have at the Federal Reserve, and take out the money as you need to see fit. And this disbursement of the loan over the years, it's in smaller disbursements, will be affected by their policy decisions. So if they agree to these policy changes, conditionality, and then they're taking out money out of the fund that they got set aside, and then they stop doing, or the IMF isn't happy with it, then they cut off the funds, and the funds won't be distributed anymore.
If you had to pick which one works better at what it does, which one?
I had to pick one.
Pick a
I mean, I'm
side.
biased. I'm biased. I don't really know why I'm biased, but I really like the World Bank. I think the World Bank, the IMF is great for what it does because sometimes you need emergency relief, but the World Bank really, I think, tries to better the world by increasing overall levels of production and technology. There's many countries in like third world is not really the correct term anymore, but developmental countries, and they don't have infrastructure. No one wants to really invest in that country because they don't know what's going to go on. They don't know how the policy situation is, if their land rights are going to be enforced, or anything, if they have the electricity capacity, the energy capacity, even road system. And the World Bank will go in there, create a report on that country. People can see what's going on in that country from their report that they generate, and then they'll go in there, give money to help promote infrastructure development, and then the capital will start coming in. Hopefully a good amount of capital inflow, not too much to create a bubble, but just enough that will start promoting development and maybe improving the lives of people there. So that's my view. That's my take on the World Bank. The IMF, I think, is great for these short-term crises, but I think, like I said before, it's a little slow to change. I don't think austerity has worked too well, and the IMF is realizing austerity hasn't worked too well in a lot of these countries, especially like Greece, I said, where they're not actually improving when they should be improving, judging by their predictions. So it's a learning process for both of the institutions, definitely.
On the same kind of note as that question, who would win in a fight, Kane? No, I'm just kidding. Don't you think that personally, I see a lot of those things that the IMF and World Bank do are heavily based in supply side economics, and don't you think that in the process they can kind of like screw countries royally by not focusing money on?
Yeah, well, that's like the thing I was saying earlier with around the Washington Consensus time. A lot of the loans from the IMF and the World Bank issued policy recommendations that today would be not really controversial, but, well, why would you do that? Or they're not actually taking into account all the data. So, for example, with Mexico, they took it in the 80s, they're giving all these loans to them, and then the 90s came, and Mexico actually controls the data they give the IMF. It's a little bit different now, but at that time, Mexican officials, they create all the data for the country. They say, here's our data. But at that time, they were kind of like, oh, where's our data? Well, we're not going to give it to you this month. We'll give it to you next month. Or maybe they're missing critical sources. And then the IMF doesn't have the whole picture. So then at that point, it can't figure out what to do. So sometimes it's not always given all the tools to actually assess the situation, which can be a problem with the data collection methods. I mean, the IMF uses a lot of econometric analysis, and they're super data focused before they give a policy recommendation through their own policy paradigms. And if that data is skewed, which it can be by countries who are giving the data to the IMF, they can affect their recommendations. That's not to say all the recommendations are perfect, and they definitely made a lot of lapses in judgment in the past years. Any other questions?
Thank you very much, Spencer, for that. For anyone who wants, I mean, I guess the World Bank supposedly is better in his eyes. For anyone who wants to know, let's say, about what he's spoken about, certain books you could read, like The Globalization Paradox is one of my favorite books I've ever read, by Danny Roderick. He's a Harvard professor. So, I mean, he writes a lot about this. He may share views, same like Spencer maybe, but I also think he just hates the IMF and the World Bank as well. There's The Body Economic, which talks about the troubles of austerity and actually links it heavily data researched on whatever's happening in the euro. Our favorite economist, Paul Krugman, writes a lot about this as well. He has a few books about it, about the financial crisis especially. And it's all, again, in the library, so I guess you guys should go and check it out. Some really great books here, and possibly some of my second home is on the 4th floor, close to the economics section. But it's a fantastic place. You guys should check it out. But yeah, these are some of the books. The IMF papers are fantastic. The World Bank as well. Just check it out. It's great for research as well. Makes you look good in front of the professors. And also just looks good in front of your friends when you back it up with something. But before we adjourn, I'm just going to say how you guys can get involved.